Okay, I think we can get started. This is the session on academic research on fintech. My name is Itay Goldstein. I'm a finance professor at the Wharton School of the University of Pennsylvania, which is obviously just down the road. I'm also the executive editor for the Review of Financial Studies, RFS, which is one of the top three journals in finance. And a couple years ago, we took the initiative at the RFS to lead research on fintech. And we had a call for research out, and we got a huge turnout from that, over 150 proposals. Out of them, we picked 10 proposals to move through the process. And we now have about 10 finished papers that are going to come out in a special issue of the RFS just in a few months. And I think will be kind of the maybe first or among the first leading papers in the academic community that are dealing with fintech. And I think since then, research in fintech, in finance has picked up, and we see a lot of activity, a lot of new papers are being written, and 4 of them are here today. So we have 4 presenters. Each one of them will take about 18 minutes to present, and hopefully we will have some time for questions later on. So the first presenter sitting to my left is Marco Di Maggio. Marco is from Harvard Business School, and he's going to talk about fintech borrowers, Lax-Screening or Cream-Skimming. I think the message he has may not be something some of you here want to hear, and my job is to make sure that he comes out of here safely. So. So let's see how we do.
Okay, so thanks a lot for inviting me. It's been a pleasure to meet some of you. I hope we are still friends after this presentation. So this is joint work with Vincent at Georgia State. So let me start with a brief motivation, since I don't really need to motivate this paper here. But I want to just focus on the credit markets. And I want to say that the fintech lenders have sort of focused on the credit markets that has reached at least $3.5 trillion in the US. And interestingly, looking forward, what's going to happen is that at least what TransUnion is mentioning is that fintech lenders are going to expand in this market, and their share of this market is going to reach 20% by 2020. Moreover, the expansion that we observed in the last few years has been pretty astonishing, because it went from a mere 1% of the personal loan market to more than 30% in 2017. And overall, their 30% is actually higher than any other financial institutions. It's higher than what the banks generate, it's higher than what the credit unions or other traditional finance originate in this market. Just so that we are super clear on what type of companies we are looking at, we define fintech lenders as those that are both marketplace lenders as well as balance sheet lenders, but we want to make sure of only looking at lenders that operate exclusively online. They have no brick and mortar presence, they don't accept deposits, are not directly regulated by the Fed or the OCC, and they have been recently founded. Because post-crisis, there have been few banks that sort of try to rebrand themselves as fintech lenders, although they were traditional financial institutions. Just to give you an example of the type of product I'm going to look at, we have talked about this yesterday. I'm going to look at personal loans. And this is just an example from SoFi. So this is their advertising of applying for a personal loan. And the characteristics are always going to be, you are going to save with respect to borrowing from credit cards. You are going to get no origination fee. And there is going to be an easy and very quick process of getting the funds in your account. So given the entry of these fintech lenders, I think there are different hypotheses that we can test, and sort of there have been different common wisdom about what's going to happen in this market. One hypothesis that I will sort of use Jamie Dimon's phrase to introduce this has been, well, fintech lenders can make loans in minutes, while banks is going to take weeks to do this. And so one hypothesis is, well, they have a lower operating cost, they are much faster, so what's going to happen is they probably can extend credit where the banks cannot really, or don't find it profitable. And so this is something that we can test in the data, seeing whether they target underserved borrowers by the traditional financial institutions. Another hypothesis is exactly on the opposite spectrum, rather than looking at the underserved, the better technology, we also talked about yesterday, the better data maybe allow them to cream-skimming. They allow them to sort of look at the best borrowers in this market that are going to overperform. Okay? And so one hypothesis is whether this is happening in the market or not. Finally, there is one alternative hypothesis, which is, well, maybe by giving access to people that didn't get access before, what you are going to show, what's going to happen is that these people are going to overextend themselves, and so may be more likely to default exposed. And the idea being, these guys were sort of credit rationed by traditional institutions. Now somehow they get additional credit. And the way in which they manage this credit is going to be very important. And some of them might actually be more likely to default exposed because they're going to end up with more leverage than they started with. Okay? So and this is basically the third hypothesis. So just so that I give away the punchline is we test the first hypothesis, the first two hypotheses, and we don't really find much evidence of being underserved borrowers. In particular, the borrowers that have a higher income, that are in better neighborhoods, that are more likely to be college educated, that tend to be professionals rather than blue collars, are much more likely to get a fintech loan with respect to one loan originated by traditional banks. This is sort of the first step, ex ante, how they look like. Then we follow their performance exposed, and what we show is that they tend to default more. Okay? So comparing for the same product, the borrowers that get the product from a fintech lender versus the ones that get it from a traditional financial institution, they are significantly more likely to default. Okay? And this is particularly concentrated among people that we would expect ex ante to be less able to manage their finances. So people that, for example, carry balance on their credit cards, people that are more likely to sort of overspend or extend themselves with credit. Okay? I'm going to be brief since I have only 15 minutes, and so I'm going to only show you the main headline points of the paper, but we have a bunch of other results that probably we're going to discuss later on. Okay, let me say one word about the data. So the data is unique in a number of different ways. I would say that so far, the academic literature has only used the data provided by two marketplace lenders, Lending Club and Prosper. It's great data. The limitation is that most of these is basically a cross-section over time of the loan applications. In contrast, we are going to use credit bureau information, which allows us to actually follow the borrowers over time. So we observe them when they get the loan, we observe them also before they get the loan, and then we observe them for an extended period of time afterwards. Moreover, this gives us access to all their balance sheet information. So we know all their other liabilities. We know some measure of consumption, like, for example, durable consumption by buying cars, for example, or how much they consume on their credit cards. We know their information about the characteristics of the different loans, from the rate to the terms to the loan amount. And we know their performance. Okay? Some version of this data has been used in some other papers, myself included. But I think these pieces of information are going to be extremely helpful. In particular, we observe the names of the lenders. So we can easily differentiate between this is a fintech lender, just because it's an household name, because it's been invited to this conference. And we observe the name of the traditional financial institutions. And so we can differentiate between these two. We have information on pricing of these loans. And for a significant sample of these borrowers, we also observe a lot of demographic information, as well as some employment information. So we know where they work and what type of occupation they have. So this allows us to basically control for a wide range of characteristics ex ante. Okay, let me just describe very quickly the data. This is just a heat map showing darker areas are more likely to have fintech loans, higher volume. As you can see, basically it's mainly concentrated in California and the East Coast, although there is some also in center. Let me also say the evolution over time. So if you follow from 2010 to 2017, the aggregate amount that has been originated, the blue one is capturing the traditional institutions. The red ones are the fintech lenders. So as you would expect, until, I would say, 2013, 2014, they're sort of a very small fraction of this market. But then basically they expand pretty rapidly in the last 4 years or so. But overall, this market has expanded post-crisis quite a bit. Okay? And this is just for the personal loan market. Okay, so let me start with some statistics looking at whether these are underserved borrowers or not. One way of testing this is Let's look at whether they get originated in what we can call financial deserts, okay? Places where the traditional institutions are not originating. So what we actually find is that the places where you are more likely to get a fintech loan are places that experience an increase in house prices, that have higher house price level, so the cost. They are also less likely to be places that have been hit severely during the financial crisis. So these are not places where sort of the banks pull back. These are also places where there is less unemployment rate, higher median income, higher fraction of college educated. There is also some correlation over time in the sense that once they enter in the market, they are more likely to enter in the market. There is also high-speed coverage and higher average bank rate. So this also says something about the competitive channel. One thing that I want to make sure it's clear so far is it's obvious that in places with low unemployment, you have more lending. But this is the differential effect. So why the fintech loans are more likely to be in those places than the traditional banks, okay? The other piece of information we can look at is just some demographic information of these borrowers. So if you are male, if you are single, if you are college educated, if you have a high income, which is defined above $100,000 per year, or if you are a professional, you are significantly more likely to get a fintech loan rather than a traditional loan. If you look at the credit attributes, so other things that we can observe on the credit report, they have lower credit score, which will make sense. I will show you in a second the distribution. They have a higher number of accounts. They have higher revolving utilization. They are less likely to have been delinquent on any account in the pre-period, so before they get the loan. They are more likely to be revolvers. So this is a transactor. This is one thing that the credit bureau gives us, which is a flag that says whether you carry balance over time, that they will call you a revolver. You're a transactor if you use the credit cards only as a minimum payment, but then you repay fully. Well, if you do that, you are significantly less likely to get a fintech loan. And if you have a student loan, you are more likely to get access to this. This also sort of shows that this is tilted towards millennials or younger adults in any case. The one more piece of evidence I want to show you about this is that it's true that on average they have a lower FICO score, but then if you look at where these are distributed, they are sort of on average above the subprime mostly. Okay, so from 620 to 740, it's where the most of these loans get originated. Okay, so just taking stock quickly of these results. Taking stock quickly of the results is that we find evidence that we don't really find a lot of evidence that these fintech lenders go to underserved borrowers, in the sense that the borrowers we observe tend to be higher income, more college educated, younger, and do have a significant credit history and are less likely to have been in default before. Okay? So bottom line, ex ante, it's great. They look great. They are not riding the demand curve. They're not going towards more and more marginal borrowers. So this also means that maybe they're concerned about where maybe there is a lax screening of these borrowers. It's not there. Now, what's the issue? The issue is the probability of defaulting ex post. Okay? So we follow their performance, and everything that I will show you here is basically the relative performance. Okay? So if these coefficients are positive, it means that the fintech borrowers are significantly more likely at 1, 2, 3, 4, up to 15 months after the origination to have an account on default. Okay? So we split these in a number of different ways. What I will show you is that this is already looking at the ones that at origination have a high FICO score. And still what you find is that basically 6 months after they get originated are about 50 basis points more likely to be in default than similar borrowers that instead borrowed from traditional institutions. This is controlling for the characteristics of the loans. So we are comparing oranges with oranges. We are comparing borrowers that live in the same zip code that they got the loan in the same exact month. Okay? So there is no vintage effect. There is no cohort effect. There is no heterogeneity in terms of geography that can explain this. And we control for a bunch of observables ex ante. This is for the high credit score. This is for the low credit score. Okay? People that ex ante are below 620. What you observe is an enormous jump ex post. There is nothing basically in the first 3 months. And then it goes up to basically 3% more likely to default after 1 year and a half. Okay? The other piece that we can look at in terms of performance is The previous one were about any type of delinquency, but we can focus on the loan performance. Okay? So now we can differentiate between being defaulting on that exact loan versus defaulting for the fintech versus the banks. And what you observe, very similar as before, there is nothing in the first few months, which is going to be expected. But then there is an increase, a significant increase ex post. Okay? So ex post, this says that they are significantly more likely to default on the fintech personal loan than on the bank loan. Now, the last piece of graph that I want to show you is that how their FICO score looks like. There is a jump of about 10 points right after the origination, which would suggest that what they're doing is consolidating existing debts. But this actually declines pretty rapidly 8 months into the loan. Okay? So this is all consistent with the fact that their creditworthiness is deteriorating pretty fast ex post. Now the question is why this is happening. Ex ante, we just said that they look better. Why this is happening? So one potential story is, well, they have self-control issues. And so rather than using all the funds to consolidate their existing revolving accounts, they consume some of this. So we can test. And we can look at their total indebtedness, excluding the personal loan, after they get the personal loan. And what we find is that basically 1 year after, their total debt increases by about $5,000. So ex post, they ended up being more levered than the ones that get a similar loan from a traditional institution. Why is that? Well, one thing that we do observe is some proxy for consumption. For example, are they more likely to purchase a car? Well, they are significantly more likely to purchase a car after they get this loan. Okay? So this also means that in some sense they're not using all of their funds to consolidate their debt, but they're consuming some of this. Another reason for why this might happen is that maybe personal loans are already sort of the bottom of the stack, but fintech might be even a little bit lower than for the banks. And so we can compare whether the loan that they get is a marginal loan or is the main loan, or better said, is coming from their main lender or from a marginal lender. So if I have a mortgage, a credit card with the Bank of America, and then I get a fintech loan, probably the fintech loan is going to be at the bottom of the stack. But if I only have that as my big financial liabilities, that means that probably I really care about repaying this loan. So the thing has, this hypothesis has some bite in the data, in the sense that what we find, for example, comparing the results after 18 months or 15 months, it's twice more likely to be in default if this loan is not the main loan. But you still find that on average, they are more likely to default than when you get it from the traditional financial institutions. The one more piece of evidence that we can say is that they get adverse selected. Probably they get adverse selected. And by definition, adverse selection is on unobservables. One unobservable that I'm proposing is that maybe there are some behavioral traits of being unable to manage your finances on which these fintech lenders get adverse selected on. Theoretically, and some of you sort of heard me yesterday night talking about this, but before we had only interest rate, and if you increase the interest rate too much, you get only the bad borrowers. Now you only have another dimension, which is speed. So if I promise you a loan in 2 minutes rather than 2 weeks, probably I'm going to get people that really need the loan in 2 minutes rather than being able to wait for 2 weeks. And that is likely to be skewed towards people whose creditworthiness is going to deteriorate pretty fast. Okay? And this is sort of consistent with the result I'm showing you here. One extra evidence that there is some adverse selection going on, we can compare borrowers that do multiple applications and borrowers that get only one application. And so these ones are the ones that get, these columns looks at their performance for the subset of borrowers that do multiple applications. It's likely that they applied to another loan and got denied, or they decided not to go for that one. They are twice more likely than the ones that only apply to one loan. Okay? So these adverse selection, I do think that sort of has some bite in the data. Okay, let me conclude with one last thing, which is, does the interest rate adjust with respect to this? You would expect that since the performance is worse, I should be able to charge a higher interest rate, slightly higher interest rate. But instead we find that the credit limit is higher, the maturity is slightly lower, but the interest rate is also lower. Okay? So you have higher defaults but lower interest rate. And this interest rate, the blue line is the fintech, the red one is the banks, The green is the Fed funds rate. In the last 2 years, we had the rate hikes. The bank's rate went up on average. The fintech stayed flat or went down. Okay? So I'm going to skip the regulatory implications. I'm going to leave you here, and I look forward to your comments. Thank you.
Okay, thank you very much, Marco. We'll move on to the second paper by Piotr Danisewicz from University of Bristol. So again, we will leave time for questions at the end.
Great. Thank you very much for attending the conference, and thank you to the organizers for including the paper on the program of this conference. This is a joint work with Ilaf Elard. And in this paper, we study how new financial technology affects household welfare. We focus on marketplace lending, and we want to see whether greater availability of marketplace credit leads to higher or lower number of bankruptcy cases filed by the residents in the United States. So what motivates our research are findings in the existing literature. So some papers suggest that marketplace credit could have some positive effects on household welfare. So although Marco doesn't show this in his paper, some previous papers show that marketplace credit lends to borrowers who previously were credit rationed by other financial institutions, more traditional financial institutions. Also, funds are available much more quickly than through more traditional lending channels. So what this means is that it may allow individuals to obtain funds necessary to overcome any shocks to their income or expenses. Also, marketplace loans typically carry lower interest rates than other types of consumer credit, such as credit cards, for example. So this may allow individuals to refinance their existing debt at cheaper rates. And subsequently, this could lead to lower number of personal bankruptcies. On the other hand, there's a growing concern that the greater availability of marketplace credit will lead to over-indebtedness among the individuals, particularly less credit-worthy borrowers who are more likely to overestimate their ability to pay off debt. And that could lead to higher number of personal bankruptcies. So in this paper, we want to test which, if any, of these two hypotheses finds support in our data. And we find that there is an inverse relationship between availability of marketplace credit and personal bankruptcy. So specifically, we show that rationing of marketplace credit will lead to higher number of personal bankruptcies, and we find this particularly true among the low-income households. To obtain these results, we rely on an exogenous event which led to rationing of marketplace credit. And we do that because simply regressing number of bankruptcy rates on the volume of marketplace credit could lead to biased estimates. So in this paper, we exploit the decision by the US Second Circuit Court of Appeals, which in May 2015, in case Madden versus Midland, ruled that loans originated to borrowers in Connecticut, Vermont, and New York can be considered null and void if the interest rate on those loans exceeds the borrower's state usury limit, and if these loans are held by non-bank financial institution. So although the case was not related to marketplace lending industry, it casts serious doubt on enforceability of certain marketplace loans. And this is because the online platforms which originate marketplace loans are not considered to be banks according to the OCC rules. So we use this verdict in our identification strategy, which relies on difference in difference estimations. So simply we compare the changes in availability of marketplace credit and the number of bankruptcy rates between affected by the verdict states and not affected states before and after the event takes place. So we obtain our results using these two specifications here, where the main variable of interest is Madden as the interaction term between two binary variables. Madden, which is equal to 1 for time periods after the verdict takes place and 0 otherwise, and state, which is equal to 1 for New York and Connecticut and 0 for all other states. So essentially, the beta 1 in specification 1 and the beta in specification 2 will inform us about the effect of the verdict on the volume and number of marketplace loans and also on the number of of bankruptcy rates. So if the beta is, for example, positive, this could actually mean that the number of bankruptcy rates increases in New York and Connecticut after the verdict relative to all other states. Okay? So in terms of the data, we use data on the volume and number of marketplace loans for Lending Club and Prosper. So we use publicly available data. The data on bankruptcy rates come from the US Courts Administrative Office, which provides information about bankruptcy cases filed in each state and month since January 2013. We supplement this information with the data from the New York Fed, which provides us with annual volume of other consumer loans, which may be affected by the verdict as well. And finally, we also supplement this data with the unemployment rates and labor force data from the Bureau of Labor Statistics. So we construct panel data for 2,700 observations, and this is basically each variable is measured at the state month frequency, and the time period is between January 2013 up until December 2017. And we cover in our analysis 45 states. So prior to discussing the main results, we performed a number of preliminary checks. So first set of preliminary checks has to do, we have to test whether our data pass assumptions of difference in difference estimations. So first assumption requires that the treatment event, so the verdict, is exogenous. So as I mentioned before, the court case was not related to marketplace industry whatsoever. We also find that there was no evidence that the court took into consideration any conditions related to bankruptcy rates in affected states at the time when when the verdict took place. So we could assume that actually this verdict is exogenous with respect to our variables of interest. Now the second assumption of difference in difference models requires a parallel trends in the evolution of our dependent variables prior to the verdict taking place, prior to the treatment event. So what you can see on these attached graphs is that the volume and number of marketplace loans and also the number of bankruptcy rates evolves very similarly among the control group and treatment group prior to the verdict. And this is important because this allows us to believe that absent the event, these trends would evolve over time similarly. And the only differences that we find are quite likely to be due to the event taking place. And also it informs us there was no anticipation of the verdict. Right? So the results that we find are actually due to the event taking place rather than some pre-event adjustments. In the second set of preliminary results, we also look what happens to other type of consumer credit. Okay? Whether the verdict affected credit card loans, auto loans, and student loans. There is a possibility that the volume of those loans will be affected because some of these loans are also originated by non-bank financial institutions. Okay? So we turn to the data provided by New York Fed, and what we find is that actually the verdict doesn't affect significantly any of those loans. Okay? So you can see that these coefficients are either low in economic magnitude or statistical significance, and we only find that marketplace loans are affected by the verdict. Okay, so the verdict actually leads to 10% drop in marketplace loans. So this analysis is performed on annual data because the data on this non-marketplace consumer credit is only at annual rates. But when we look at the state month frequency of data, we actually confirm these results. Okay, so here we look at the volume and number of marketplace loans, and we see exactly the same results using this higher frequency data. Okay? So we see that the volume drops by about 10% and number of marketplace loans drops by approximately 13%. Now we look a little bit deeper into those results, and what we find is that actually this credit rationing intensifies with borrowers' risk. So what we see is that the borrowers with a rating of 1, those are the most risky borrowers, they experience the highest rationing of marketplace credit. And this coefficient of minus 1.715 actually translates into 82% drop in marketplace credit. And you can see that also the least risky borrowers, they actually experience no effects at all. And this is very intuitive because the most risky borrowers are more likely to borrow at above usury rates, okay? Unlike the least risky borrowers. And we find this effect similar in terms of number of marketplace loans. We also look what happens to marketplace lending in terms of loans. We look by the purpose of the loan. Okay, so what we find here is that loans requested for paying medical expenses observe the strongest effect, actually 68% drop in those loans. We also see that debt refinancing loans exhibit a significant reduction, and also loans for small business, for paying for small businesses. And this is important because existing studies show that medical bills and also inability of individuals to refinance their debt are among one of the main reasons why people file for bankruptcy in the US. Okay? Right. So now moving on to our main results, we look at how the verdict affected bankruptcy rates. And what we see here is that following the verdict, the number of personal bankruptcies in New York and Connecticut increases by 8% relative to all other states. And this is mainly driven by the increase in bankruptcy, Chapter 7 and Chapter 13 bankruptcies. Okay? We also look at the nature of the filing, whether it's a consumer bankruptcy or a personal business bankruptcy. And here we find that the main effect is on consumer bankruptcy, so the individuals filing for bankruptcy. But we also find some effect on Chapter 7 personal bankruptcy. So what these results are showing us so far, what they suggest is that rationing of marketplace credit leads to significant increases in the number of personal bankruptcy. To better link the two, we perform additional analysis where we split our sample based on the income of the bankruptcy filers and the income of marketplace borrowers. So we just repeat our results for these different income groups. And what we find here is that the individuals with the lowest income, so below 25,000 US dollars, they experience highest rationing of marketplace credit, and they are more likely to file for bankruptcy. And you can see how this increase in personal bankruptcy is proportionally intensifies with the marketplace credit rationing. Okay, a few other additional tests. So we also showed that that these effects that we observe, they're not just temporary adjustments, they actually persist over time. And if anything, the effects on the bankruptcy rates and availability of marketplace credit are stronger in the second and the third year after the verdict takes place. We also rule out some alternative explanations. So we rule out the possibility, we want to see whether these bankruptcy rates increase due to credit ration borrowers switching to high interest credit, such as payday loans. And here we find that this is not the case. We also rule out the possibility that it's the existing marketplace borrowers who contribute to an increase in bankruptcy rates. To this extent, we observed that the verdict didn't affect defaults on marketplace loans. We perform a number of other robustness checks just to test whether our results are sensitive to, for example, clustering of standard errors or choosing the control group. But all these tests actually support our baseline inferences. So just to conclude, what we show is that reversing access to new lending technology affects personal bankruptcies among low-income households. And this is important because bankruptcy affects not only individuals who file for bankruptcy, but also other players. It also has got some significant macroeconomic costs. And finally, our paper also provides some, at least we believe that it provides some interesting policy implications. So at the moment, there is a bill pending in the US Senate which tries to overrule the decision of the court in case Madden versus Midland. And I think that our results are showing that perhaps this wouldn't be the worst idea to do that. Okay, thank you very much.
Okay, thank you, Piotr, for restoring the confidence in fintech lenders. And we're going to move on to the third paper, consumer lending efficiency, commercial banks versus fintech lenders.
I'm used to a touchpad. I'm not doing very well with this. Can't find the cursor. Once this goes flat, it stops working. Thank you. Well, the title of the paper in the program is has a typo. It should say a comparison of lending efficiency of commercial banks and a fintech lender, because we're only looking at one fintech lender. And this is joint work with Julapa and Choon-Geol. We're going to be looking at unsecured consumer lending by banks and lending club. Unsecured consumer lending excludes auto loans, home equity loans, and home equity lines of credit. And we'll focus on the volume of non-performing unsecured consumer loans, which we define as the sum of past due plus gross charge-off loans. And we include charge-offs to eliminate any bias in the aggressiveness with which institutions charge off. And so in particular, we'll be looking at the ratio of non-performing unsecured consumer loans to total consumer loans. And by efficiency, we're going to be looking at the performance of unsecured consumer loans. We'll take the observed non-performing consumer loan ratio and we'll estimate a best practice ratio that's conditioned on the scale of lending, economic conditions in the lender's local markets, and the lender's average contractual interest rate. And inefficiency will be defined as the difference between the observed ratio and the best practice ratio. How do we, let's look at some data. Here's 2016, and we have the non-performing consumer loan ratio on the y-axis, and on the x-axis, the log transformation of the volume of consumer loans in thousands. And there's Lending Club, and you'll notice that the non-performance rate is roughly increasing with the volume of consumer lending. There's Citigroup and Capital One, and here's a small lender with a very high non-performing loan ratio. If we look at some summary statistics by asset size groups, we see that the largest banks with assets greater than $250 billion have a non-performing loan ratio of about 4.5%. And if you look at the trend across as size increases, you'll see that the non-performing loan ratio is increasing by asset size. And if we look at the largest banks, that 4.5% ratio is this relatively high ratio the result of making risky loans that are more likely to default, is it possibly less skill at assessing credit risk and managing loans? And so if we look at the non-performing loan ratio by the volume of consumer lending, you'll see that the largest lenders, greater than 10 billion in consumer loans, have a almost 5% rate of non-performance. The second largest group, 1 to 10 billion, 4.2%. Lending Club belongs to that group. And if you look at the smaller banks, less than $1 billion in consumer loans, they have a much lower lending rate, almost half. And there's Lending Club, and Lending Club's rate is very similar to the median for its size group. If we look at 2013, we see the same pattern. The largest banks by asset size have a non-performing loan ratio of 6.4%. And if we look at it by volume of consumer loans, lenders with over $1 billion in consumer loans have a very high rate of non-performance. And Lending Club, on the other hand, has a much lower rate and tends to resemble the rate of non-performance of smaller consumer lenders. So our research task is going to be to decompose the non-performing unsecured consumer loan ratio into the portion due to lending to risky borrowers who default more often. We'll call this inherent credit risk, and the portion due to less skill at assessing credit risk and managing loans, we'll call this lending performance inefficiency. And we'll compare Lending Club to traditional banks by these two measures. How do we get best practice? Well, we'll estimate best practice, or this minimum non-performing loan ratio, by stochastic frontier techniques, which will eliminate the influence of luck. And it will give us the ratio a bank would achieve if it were fully efficient at credit risk evaluation and loan management, and we'll call this minimum its inherent credit risk. And by fully efficient, I mean fully efficient relative to its peers, and we'll define peers in terms of lenders with a similar GDP growth rate, similar banking market concentration, similar volume of consumer and total lending, and a similar average contractual consumer lending rate. And these peers, how do we choose these variables to define peers? Well, Loretta Mester and I wrote about this in the Oxford Handbook of Banking, and I'm just going to quote from what we wrote. These variables define the peer group that determines best practice performance against which a particular bank's performance is judged. If something extraneous to the production process is included in the specification, this might lead to too narrow a peer group and an overstatement of the bank's level of efficiency. Moreover, the variables included determine which type of inefficiency gets penalized. So, for example, if bank location, urban versus rural, is included in the specification of the frontier, then an urban bank's performance would be gauged against other urban banks, but not against rural banks. And if a rural bank's performance would be judged against other rural banks. But if it turned out that rural banks, for example, are more efficient than urban banks, all else equal, the inefficient choice of location would not be penalized. So this is going to motivate the specification of the frontier. And so what characteristics of lenders and their environment do we include to define peer groups? Well, economic conditions in their local markets, the GDP growth rate, and the banking market concentration. We'll include the scale of lending, which will in part capture the technology used and the potential to diversify, and we'll include the average contractual interest rate charged on consumer loans, since higher rates will lead to adverse selection of borrowers in terms of credit risk and poses greater financial pressure on borrowers. Now, there's certain lender advantages that will improve borrower selection. So that means better credit risk would apply for any particular average contractual interest rate. And examples include the geographic convenience of a local lender, a lender that offers a convenient application process, a lender that makes speedy credit decisions, and a lender that is trusted. And so better selection reduces the expected non-performing loan ratio at any contractual interest rate and would show up in our analysis as greater efficiency of lending. Here's the specification of the frontier, and I'll move quickly through this. So the non-performing loan ratio is regressed on a set of variables: the total consumer loans and loans squared, total loans and total loans squared, total consumer loans interacted with the contractual consumer loan rate, total consumer loans interacted with the GDP growth rate, the interaction of that volume against the Herfindahl index, and the interaction of the contractual rate against the Herfindahl index. And finally, a composite error term, and this is what's going to define the frontier. Nu-I is a two-sided, normally distributed error term that captures statistical noise, while mu-I is a one-sided positive term, exponentially distributed, that captures performance inefficiency. So if we look at the estimation of the frontier, the kernel defines best practice. The portion of the ratio due to statistical noise is nu-I, and if we subtract nu-I from observed performance, we get noise-adjusted performance. And mu-I is the inefficiency term. And so this estimated frontier gives us a three-part decomposition. We observe the best practice, or the minimum non-performance, which we'll call inherent credit risk. We observe the excess non-performance, which we'll call inefficiency. And we get statistical noise. And if we look at that equation again, estimate it, and subtract statistical noise from non-performance, we get noise-adjusted non-performance. And if we subtract best practice, we get excess non-performance, which is inefficiency. So that's how we're estimating inefficiency. And caveats, this applies only to Lending Club. We don't observe data during an economic downturn, and we're not considering profit or cost efficiency of lending. And we compare top-tier US bank holding companies with Lending Club in 2013 and 2016. Let's look at 2016. So here's that non-performance plot again, and the blue crosses toward the bottom are the best practice values. And I'll blow it up a bit and focus on Lending Club. Lending Club's red cross, its observed non-performance corrected for noise, is almost identical to its best practice. And if we blow it up still a little bit more, you can see that their best practice is almost, there's best practice, and there's almost no inefficiency for Lending Club. Here's Citigroup, same story. Observed non-performance and best practice are almost the same. And that's true as well for JP Morgan Chase. You'll notice that most of the largest lenders have this very high degree of efficiency. There's Bank of America, a little less efficient. And here's SunTrust, which is quite inefficient. Most of its non-performance is due to inefficiency. And there's Lending Club. 2013, Lending Club has a little bit lower degree of non-performance and a best practice ratio that's considerably lower, and it has lending inefficiency that's quite a bit higher than what we observed in 2016. So 2016 medians, the noise-adjusted ratio, the best practice ratio, which we'll call inherent credit risk, and the excess or inefficiency. So if you look at the smaller lenders, this is by volume of loans, their non-performing loan ratio is rather low compared to the largest lenders. And remember, Lending Club belongs to that group of 1 to 10 billion. And if you look at Lending Club, you'll see that it's very similar, as I just pointed out. And Lending Club, most of its non-performing ratio is the result of inherent credit risk. And that's true as well for the largest lenders with greater than 10 billion in loans. And the result then is that the inefficiency of the largest lenders and lending club is very, very low. And if you were to compare it with lenders in the 1 to 10 billion range that Lending Club belongs to, you'll see that most of their non-performance is inefficiency rather than inherent credit risk. So Lending Club has better performance than its peers of the same size. And this is the non-performing loan, the inefficiency of smaller banks, and you'll see most of their non-performing loan ratio is due to inefficiency rather than inherent credit risk. And a similar pattern is found in 2013 data. The smaller lenders have a relatively low rate of non-performance. Lending Club resembles, in this case in 2013, the smaller lenders' non-performance, as opposed to, and their best practice is very similar to the smaller lenders, and their inefficiency is very similar to the smaller lenders. While if you look at the larger consumer lenders, they have a much higher non-performing loan ratio, over double that of the smaller lenders. And for the lenders greater than 10 billion, most of the non-performance is due to inherent credit risk. Their inefficiency is very low. And if you compare it to the 1 to 10 billion range, it's the opposite conclusion. Most of the non-performance is due to inefficiency rather than inherent credit risk. So the last question we ask is, why is non-performance so high at the largest institutions? And in a paper Choon-Geol, Moon and I wrote, we look at top-tier bank holding companies in 2013, the non-performing loan ratio of all types of loans, and we find that the non-performing loan ratio is negatively related to market value at smaller banks and positively related to market value at larger banks. And this suggests there's a dichotomous value maximizing lending strategy that differs by bank size. And there's an explanation for this in terms of charter value, which Marcus in 1984 proposed, and Dick Herring and a co-author proposed about the same time in a Journal of Finance paper. If we take this breakdown between best practice and excess non-performance, we see that the largest financial institutions in 2013 have the highest ratio of non-performing loans, the highest inherent credit risk, and the lowest lending inefficiency. So that's a result very much similar to the consumer loan ratio. Higher inefficiency is associated with lower market value at all banks. Inherent credit risk, interestingly, higher inherent credit risk is associated with lower market value at 140 smaller banks, but it's not statistically significant. But interestingly, higher inherent credit risk is associated with higher market value at 104 banks larger than 3.3 billion in assets, and it's statistically significant at 37 of the largest of these banks. And it again suggests evidence of dichotomous value maximizing lending strategies. And Loretta and Choon and I have found a similar result for capital structure, which is suggesting that the largest banks improve market value by taking more credit risk and by increasing leverage, which suggests that the capital market may not be disciplining the larger banks in a way that promotes financial stability. And so I'll skip the conclusions in the interest of time. I'll just note that Lending Club in 2016 behaves much more, its consumer lending platform behaves much more like the very largest bank lenders with 20 billion or 10 billion or more in consumer loans. Thank you.
Okay, thank you very much. So we will move on to the last paper by Tatiana Balyuk from Emory University, Reintermediation in Fintech, Evidence from Online Lending.
So thank you very much for inviting me to speak and to present my research. This is joint work with Professor Sergei Davydenko, who's at Rutman School of Management, University of Toronto. Oh, that's a PDF, Sorry, should have been the PowerPoint, so it's a bit messy. But let me just skip to the next slide. So online platforms such as Airbnb, Uber, or eBay were designed to bring sellers and purchasers of goods and services over internet, and these platforms were designed to mitigate matching and search frictions in a number of different markets. The rise of fintech has often been thought of having the same impact on financial markets. So if you think about the peer-to-peer lending platforms, for example, these were often thought as financial disruptors in the marketplace, something that is meant to be an antithesis of the Wall Street. And often, if you think about peer-to-peer lenders, especially in their early days, they were often referred to as loan crowdfunding websites. So the initial idea was to disintermediate lending, basically creating decentralized markets where users and providers of finance could transact directly. So the question we're asking in this project is basically whether we will see disintermediation and further disintermediations carried by fintech, or we will see reintermediation in those financial markets. And we study evolution of one of the peer-to-peer lenders, specifically Prosper Marketplace. We do provide some additional data from Lending Club to support our conclusions. So I'm sure the sophisticated audience here is very familiar with how peer-to-peer lending works. But for those of you who have basically no idea, I'll give you a 1-minute introduction. So peer-to-peer lending basically is a two-sided market. So on the one side, we have borrowers. So those borrowers come and apply online. They submit a loan request, and they provide access to their credit bureau data. So most of the data that is used nowadays is hard borrower data. On the other side of the market here, we have investors, and those investors are able to perform a number of different functions. So those investors could screen loans themselves by writing their own screening algorithms. They could handpick the loans by manually searching through the loans, and they provide funding. However, in the middle between the two, we have this black box, which is the platform. And I intentionally put the question mark here because this is the focus of this paper. So the question is what this platform is doing. The platform could be either acting as a broker, so as a loan originator, or it can undertake more functions, such as loan screening. And under loan screening, we mean pricing and credit adjudication, or it can do loan servicing. And the important distinction between this market compared to other online markets is that information asymmetries are very important in that market. So we have borrower adverse selection that has to be mitigated by someone, either investors or the platform. So the question is that platform, is that black box in the middle really a trading venue that's just doing the matching between the two? Or is it a real intermediary right now? And this has implications for what the platform's functions are, what is the interaction between the platform and investors, and whether we can see any incentive problems in the current market structure. So I'd like to mention that reintermediation is not really obvious. As you have probably guessed from the title, we'll be showing that peer-to-peer platforms look more as like intermediaries nowadays. However, this is not really obvious, as many different arrangements exist in other markets. Take electronic communication networks, ECNs as an example. These are automated online platforms that match buy and sell orders for securities. So these platforms have not evolved to being intermediaries. They stay as a disintermediate market. And we argue that why peer-to-peer lending is especially susceptible to reintermediation is because hard information is so prevalent in those markets, as opposed to soft information and private information in other markets such as securities. So the presence of predominantly hard information leaves less room for divergence of opinion or for improvement of the screening algorithms further in those markets. Okay. So let me give you the preview of our results. So first, we report some stylized facts about the market. And those stylized facts to us suggest that this market looks more like an intermediated market, with a platform software being a new intermediary. We show that peer-to-peer investors are currently mostly sophisticated, passive, and algorithmic. So remember, this is a US market, US platform we're looking at. Secondly, we show that investors predominantly rely on the platform's pricing and screening algorithms. So they're happy to grab almost all the loans at the prices set by the platform. When we look over time, we see the substitution between screening by investors and screening by the platform. So it looks like over time, the platform, most of the rejections in that market are coming from the platform rather than from investors. We look more into the platform's role, and we find evidence suggesting that the platform processes information efficiently. So we look both at pricing and credit adjudication, and we look at returns. What we find is that returns in that market have been declining over time on the net. So this is after defaults, consistent with reintermediation. Lastly, what we really contribute is a discussion of moral hazard and incentive issues. Moral hazard by the platform, potential moral hazard by the platform, as we are showing, is mitigated by the threat of investor withdrawal. So the bottom line here in our project is that we see evidence of reintermediation, and the growing technological expertise of the platform crowds out loan screening by investors in that market. So let me give you some theoretical intuition behind our results. So you'll see a lot of graphs in the presentation. I'll refer you to our paper if you would like to see more robust empirical tests. So we built on a model by Vili and Zhang. This is one of the papers that has been accepted in the Fintech issue. So our compliments to Itay for selecting a paper that has a very rich theoretical model, and we can derive a lot of testable predictions from that model. So one equilibrium in that model is what we call a disintermediated market. So what do we see in that market? We see investors in that market who are really active and who are screening loan applications, obviously in search for alpha in that market. And we see the platform that acts more as a trading venue. So in that equilibrium, the platform is really passive. It provides infrastructure to match borrowers and lenders. So its key role is facilitating transactions rather than screening of borrowers. And this arrangement is akin to bond markets, where investors can screen corporations, for example, as they have some additional private information, or may have additional private information, or can screen on a different, many variety of dimensions. So this market happens when investors are better at screening, either because investors have more information costs are low, as in their model, or because inherently investors are better at screening. For example, there is a wisdom of the crowd effect. So investors develop their own screening algorithms. The platform stays passive as investors employ more active investment strategies. And as a result, only skilled investors invest, and loan returns are high in that market. Another possible equilibrium is the so-called intermediated market. So what are the features of that market? We have investors who are passive, and I'll explain in a second why. We have the platform that is active. So the platform does most of the loan screening by setting interest rates, by denying loans. Here, this market is akin to securitized market, because the platform basically does all the job as an intermediary, and investors provide funding. So we have, in contrast to traditional banks, we have that separation of funding and loan origination. However, this arrangement is quite similar to securitizations that we've seen a lot prior to the financial crisis. So in that market, the platform is better at screening. Either initially or over time, the platform learns faster than investors do. Loan maximization volume incentivizes the platform to screen. Investors respond by becoming passive. And this is because over time, as the platform increases its screening abilities, returns to screening go down. So at least for some investors, they find that the costs of screening is above their returns to screening. So they become passive and invest passively in the cross-section of loans. So here, just to give you an idea of what we mean under passive investment. So under passive investment, we really mean passive loan picking. So active investment means that the investor has access to information about the underlying loans. The investor can screen every single loan application, either automatically or manually, and decide whether to invest. By passive loan funding, we mean that investors can either give all the funds to the platform and rely on the platform screening, or they can preset some general criteria, such as we want AA-rated loans or B-rated loans, and then ask the platform to invest on their behalf. So it is not completely passive, but this is much more passive than doing screening of each loan application. So in that equilibrium, what happens is that even unskilled investors can invest if they can break even in that equilibrium. And given that the platform increases its quality of screening and we have unskilled investors, the platform does keep some lower quality loans in the mix, and returns net of defaults go down. So compared to that model, what do we have to bring to the table? So we focus. So first of all, this is not what the Williams-Zahn model basically tests. What they're testing for is the trade-off between the screening and information provision by the platform. So in contrast, what we focus on transitions between equilibria by studying the evolution of one of the markets. We provide stylized facts about the peer-to-peer loan market. We use data from Prosper's platform to test our predictions, which will follow on the next slide about reintermediation. We also provide methodology for computing peer-to-peer loan returns. And this is important because on Prosper, there is no secondary market. And some of the loans have not, the defaults on some loans have not materialized yet, as the loans have not matured. So if you really want to value loans that are really young in terms of their age, this methodology would be more appropriate, as we think at least. And also, what is not in Williams-Zahn's platform, we discuss problems, the platform's moral hazard issues and whether they can be mitigated. So if you think about an intermediated market overall as being similar to securitization, debt securitization has been argued as one of the reasons of the financial crisis that existed. And that was because banks who originated loans that were subsequently prepackaged and resold presumably had little incentives to ensure that the loan quality is high. So if we see an intermediated market in fintech, what does it mean for financial stability for the next financial crisis? And does the platform really have incentives to ensure that its pricing and screening algorithms are accurate in credit adjudication? Or does the platform has incentives to deviate from that screening? So we're testing a number of hypotheses. So we're looking at investor investment strategies. And to differentiate between intermediation versus reintermediation, we look at the evolution. So the fact that investors are becoming passive over time would suggest reintermediation. Investors becoming more active and learning over time would suggest disintermediation. When we look at the platform's screening ability, when the platform can really screen and when the platform becomes a real intermediary, then we would see more skilled screening over time. As opposite in the disintermediation case, the platform will remain passive. Lastly, we look at loan returns. And loan returns are expected to go up if there is disintermediation, and investors, again, learn and screen more. And loan returns are expected to go down if there is reintermediation. So what this graph is showing you the evolution of investment pool on Prosper Marketplace. So the gray pools are institutional investor pools where institutions can invest. And the dark gray one is the passive strategy, so passive loan picking. Whereas the white one is the share of retail investors on the platform. So what we report is that peer-to-peer lending is not peer-to-peer more, so it's overwhelmingly institutional. And also, when you look at the share of the passive strategy, it has grown over time, consistent with reintermediation. This graph plots funding rates by loan rating. So this is Prosper's own proprietary rating, with AA-rated loans being the safer ones, HR loans being the most riskier ones. Strikingly, funding rates are close to 100%. They are like 98% now. So investors seem to be relying on the platform's pricing and happy to grab almost all of the loans based on the prices set by the platform. The lending platform can verify loan applications, and the platform can cancel some loan applications in the funding process or ex post after. However, when we split the cancellations by funded versus non-funded status, we see that historically investors did not shy away from loans that are ex post more likely to be canceled. So this suggests to us that investors trust the credit adjudication algorithms of the platform as well. Looking at the dynamics, the solid line shows you the percent of loan applications that are unfunded by the platform. And you can see here it's really low, consistent with high funding rates. So this is the opposite of the funding. And the dotted line, the dashed line, shows you the cancellations by the platform. In those two events, this is the switch from the auction model. So the platform starts setting its own interest rates on the loans. And here, this is introduction of institutional investor pools. So you can see that over time, the platform has become dominant. So loan screening by investors have been replaced by the screening by the platform. Now, how is the platform doing in terms of the quality of screening? What is shown here is the default rates on Prosper loans by FICO score bin and by the Prosper rating. So the Prosper sets expected loss rate on every loan application, ELR, and that expected loss rate is then mapped to a unique interest rate and mapped to a rating. So if you just look at this column here, for example, A-rated loans, you do not see many substantial differences between defaults among different FICO buckets. However, when you condition on the FICO score here, the discriminating power of Prosper rating seems to be high. So one caveat is that Prosper rating does include FICO, but what it tells us is that it does provide incremental information. And this graph shows us cross-sectionally how good the platform is at predicting defaults. This is so-called ROC curve, which basically shows you how well can we identify defaults. So perfect identification would be reached if the area under ROC curve is 1. Very bad identification if that's 0.5. So we see around 65% to 70% in terms of identification, which is considered to be very good in information-scarce environments. And the quality of the platform screening has been increasing over time. I won't go through these results much now, but what we find is that loans that get canceled by the platform are indeed more riskier. And this is because we look at resubmitted applications, and loan returns go down over time. And we just want to quickly, in the last minute that I have, I'll quickly talk about moral hazard issues. So peer-to-peer lending platforms do not have much skin in the game, and this raises questions about whether there is some Lax-Screening that is possible. And we provide evidence of a Moody's downgrade warning for Prosper-backed securitizations. And you see that here, realized returns, which is blue bar here, have been below the expectation by the platform leading up to the Moody's warning. So Moody's warning was in February 2016, which is followed by market collapse. So just imagine 93% down in loan originations. However, the platform has revised its model and the loan volume has largely recovered. Just to wrap up, what we are finding evidence of reintermediation in the peer-to-peer loan market. And most investors are now becoming passive. The platform resembles more of a traditional intermediary. And the lesson we learned from the Moody's downgrade case study is that the possible moral hazard issues by peer-to-peer platforms are checked by the threat of investor withdrawal. Thank you.
Okay, thank you very much. So we have a few minutes for questions from the audience. Let's see who Yes, if you can please tell us your name and where you're from.
John Wharton from TransUnion. Thanks. Hi, thank you. Firstly, thank you all for your studies, very illuminating. Appreciate that. Would like to focus in on your research, Marco, and first with a comment and then a question. In terms of increasing access to credit, I think it's important to highlight that it's actually occurring across the entire risk spectrum. Because what lenders, if we look at the fintechs, we're working with almost all of the top 25, and the vast majority of them are leveraging our trended data for marketing and underwriting. And what it's enabling them to do is, like, if you look at with traditional credit scoring, if you had 3 consumers at 700, they would all look the same. With trended data, you go back 30 months, perhaps one was an 800, another one was a 700, and another one was a 600. Suddenly you have a very different view. And so for the ones that were that 700 30 months ago or 600, those might have been, like the 600 may have been rejected under using traditional credit data. So that consumer is able to get access or at a better price. And the consumer who is at an 800, perhaps with a traditional score, the lender would approve. They're now able to get better insight, and then the lender is able to take on less risk. So there's a mutual benefit both to the consumers who, with that additional insight, get a greater access, but also greater protection for the lenders. But the other point, and this is really the question, and I think we looked at very similar things in the study that you presented and what I shared with the group yesterday. And really the question that I have is about sampling. And I just rough eyeballed it. I'm just trying to understand here, because that is, my understanding is that's not TransUnion data. And we look at the share of originations in 27, rough eyeball came to around 20%. And I know from our database, it's at 36%. And I know one of our peers, about 18 months ago, published an article in the American Banker, putting out a public plea to get the fintechs to report to them. So one thing would just be alignment in terms of making sure that we've got the full visibility of the market. But then a second question about sampling. In the definition of fintech, did you include debt settlement companies? Because there are some debt settlement companies out there that would meet the definition of fintech, but the lending, and for those of you that aren't familiar with debt settlement, in 2010, the FTC updated the telemarketing sales ruling so that debt settlement companies can no longer recognize their revenue up front. And so there actually has to be an initial payment on the settlement before they can recognize the revenue. So there have been quite a few debt settlement companies that have launched lending arms, and in lieu of an accumulation account, they use those loans to fund the settlement process. And the nature of settlement is a consumer stops making payment to lenders, and their score naturally then declines as part of that process. So just wondering if you could comment on the sampling, please.
Okay, so about the first comment, I don't think that I made any sort of claim about giving access to different type of borrowers across the distribution. So I think we are sort of on the same page there. In terms of sampling, I cannot disclose which credit bureau is that, but in terms of the definition of the fintech, I completely understand what you're saying. Freedom Financial is, for example, the first one that comes to mind. We do this without them. Those type of debt settlement firms don't actually drive these results. That would already been suggested by the picture that I showed you in the FICO, because the FICO actually goes up, which was already saying that most of the customers, most of the borrowers are not defaulting like it's required basically from these debt settlement firms, because otherwise the FICO would go down. And so we are actually skewing towards already sort of the ones that are getting some benefits out of these personal loans. In terms of coverage, different credit bureaus have access to different lenders. I don't want to disclose sort of the credit bureau or the lenders, but I can tell you that most of the people in this fintech company, this conference has been sort of in the sample. And we sort of careful of having a definition that is restrictive versus a less restrictive one. The one that I showed you is the most restrictive one. What's the difference is because sometimes in the credit bureau data, there are going to be some banks that figure as the main originator. But those banks actually are the fronting bank for a fintech lender. We heard yesterday from Cross River Bank, from Web Bank. We don't include those, and we include those. The results are extremely similar. Okay. So there is some judgment to be made about that, but it doesn't seem that it's the main driver of the results.
Okay, let's see if we have more questions. Yes, please.
Professor Danisewicz, pronouncing that right? Yeah. Oh, okay. Just in your findings, I know that there was an earlier study from now SEC Commissioner Robert Jackson on the impact of the Madden decision on access to credit access, and I think it was sort of initially accepted as pretty powerful evidence of what happened in the pullback post Madden, but it was criticized for not being as comprehensive. Do you have views on the ways that you or others could study the exogenous impact of that event in a broader way, or in ways that previous study either is consistent with your study or not consistent?
So there's a couple of questions we do want to answer with using this data, using this exogenous event. There's plenty of different questions you can answer related to household effects. So how marketplace credit can affect households. And definitely this is something that we will try to work on. Yeah. The paper that you're mentioning, actually my co-author would probably be more concerned with that. I mean, I'm not aware of that paper at the moment. So, which could you?
Yeah, maybe. Yeah, maybe we can do it later.
Yeah, maybe we can discuss later.
Yeah.
Thank you for the interesting papers. Clearly, there's an interesting combination of approaches, but also issues with access to data sets, right, that were just brought up in one of the earlier answers. And I'm wondering if you could share with us your perspectives on how the industry might be able to give academics access, and if there have been efforts and openness between regulators, credit bureaus, and lenders to facilitate more analysis on bigger data sets with access, to maybe a sort of editorial or access committee to assure that that's done without political or too much industry influence.
So who wants to take this based on your experience?
So I would love to have access to data. So I will leave my business card to everybody that who actually wants to share data. I've seen some resistance, which is understandable because there is only a headline risk here. That whoever sort of put themselves out there saying, I'm going to share my data, and then whatever, by being independent, then I will be able to sort of publish whatever ex post I find. There is only sort of downside risk for many of these people, because if there is some, and there has been some cases like this, right? For Airbnb, the discrimination paper has been sort of a big hit on their side, and I'm sure that sort of these type of concerns are very prevalent here, and so I found very difficult to get access from lenders, except from Lending Club, that since the beginning sort of is doing this. So the only way which there is access is by having an intermediary. So somebody else, like the credit bureau, who is in between and is willing to share data that are anonymized and has sort of no stake in this, or some other vendors that are happy to sort of collect publicly available data, or that gets data from both sides of this market. During the crisis, there have been for example, Black Box or CoreLogic that, for example, collected the securitized loans data, and that has been super powerful in academia to study that market. I haven't seen anything for these fintech lenders now.
Okay, I think
Let me just add to this a little bit. So the reason why we have peer-to-peer loan data that is rather public is because of the SEC's involvement, because these are treated as borrower-dependent notes, so basically as the securities. And then the ESCC mandates disclosure of some of that data. But still it's good that the industry is being so open and transparent. There is less data available on other types of lending, such as small business lending, balance sheet lenders, obviously. So as researchers, we would love to get access to the data, but I would like to disagree a little bit on the point that there is only downside, because as fintech is a growing and young industry, obviously wants to get some credibility. And there are many questions that we as researchers are better equipped to answer, such as does it have real effects? For example, does small business lending have an effect on local employment, local markets? And I think that there are both the downside and the upside to sharing the data. So please do consider sharing the data with us and working jointly on projects.
Okay, I think we can end on this note, which I think everyone here agrees with. So that was a great session. I think we saw 4 different perspectives on fintech, and hopefully the research will continue and teach us something about this very interesting industry. So please join me in thanking everyone.